Hi, my name's Griffin Bridgers. Today's video is about the lack of control discount you can get sometimes on an intrafamily transfer of an entity interest, like a corporation or a partnership or an LLC. And what we're going to start with is kind of the root of that idea, Revenue Ruling 93-12, in the area of transfers of corporate stock. Now, before we get started, I want to remind you this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So before jumping into the ruling itself, I'm going to set a little bit of foundation for you, which may be basic for some of you out there, but if you're new to this subject, is going to kind of help you see the lay of the land. So it's common in families where wealth is not necessarily held individually. Instead, it may be in the form of business interests or business operations that are usually in entities like a corporation or a partnership or an LLC, and interests in these entities tend to be held by family members. They might have the majority of those interests, or at least a significant chunk of them, sometimes all of those interests. And it's routine that as part of an estate plan, those interests get transferred among family members either by gift or by transfers at death. That could be part of the estate plan. It could be part of the overall business succession plan, whatever the case. But where the issue comes in is what the value of those interests might be if they're not sold. If they're transferred by gift during life or transferred by inheritance at death, in either case, there's a value you have to determine for gift or estate tax purposes, and that's the fair market value of the entity interest itself, which may just be a fraction of the business entity. But one tension that comes in is where you have family members involved, because the fair market value, amongst other factors, is usually based on the price at which a willing buyer and willing seller who are unrelated at arm's length would sell or exchange the entity interest. So because we're assuming that buyer and seller are unrelated, can we use the same fair market value concept when it comes to transfers between a buyer and seller who are indeed related? And the tension involved relates to discounts. So what are discounts? Well, there's a variety of them that you can use in this context. Most often you see a discount for lack of control and a discount for marketability when it comes to a family entity or even any closely held business entity. Now, for this presentation, in the context of the ruling we're going to discuss, I'm going to focus on corporations, but as I mentioned, other entity forms can be subject to the same analysis. But corporations create a good kind of focus on how you separate out authority within a business entity. Now, if you owned a property directly, you're free to control that property and take the income from that property and buy and sell it when you wish. But when property is owned by an entity like a corporation, then individual shareholders don't have that right. Instead, kind of like in democracy, corporations usually have elected officials who might make day-to-day decisions at the officer level and higher-level decisions at the director level, so that everything does not have to go to a shareholder vote. Because if every decision was up to a shareholder vote, nothing would ever get done. The shareholders delegate the more routine types of matters to layers of bureaucracy within the corporation itself. And in the case of a corporation, usually what happens is that you have directors that control the high-level decisions, and one of those high-level decisions is the decision to declare dividends from the corporation's net earnings and profits, and maybe other distributions from the corporation to the shareholders as well, maybe in the form of redemptions or stock buybacks. And as a check and balance in this director-shareholder dynamic, usually a majority or sometimes a supermajority of the shareholders have the power to remove and replace directors. So it stands to reason that if you had one person alone who had a majority of the stock, they would have the power alone to remove and replace directors, and thus have the same benefit from the property that's held by the corporation that they would have had if they owned that property individually. But it's rare, especially in a family scenario, that one person alone can remove and replace directors. And that would usually require that person to hold the majority of the stock by themselves, which requires usually greater than 50% ownership of all issued and outstanding stock. So what this means is that if 50% or less of the stock is transferred by one individual, the fair market value of the stock may be subject to a discount below its proportionate book value of the underlying corporate assets. And that discount really reflects the lack of control that that one person alone who's transferring the stock would have to benefit from corporate property when compared to a situation where the person just owns those corporate assets outright. But remember here that this fair market value and the possible lack of control discount assume that the buyer and seller are unrelated, because in an unrelated scenario, it's assumed that shareholders usually wouldn't act in concert to create a majority block to remove directors unless it's in their best interest and in the best interest of the corporation. So what does this mean when family members are involved? Does that mean that family members can't have a discount for lack of control because they're more likely to act in concert and give each other sweetheart benefits? And the answer is no under Revenue Ruling 93-12. So the facts in this ruling involved a gift of 100% of the corporate stock by one individual in equal shares of 20% to each of the individual's 5 children. So at issue was whether the lack of control discount would apply to each 20% gift of stock. Now look what's happening here. If the one individual transferred 100%, there'd be no lack of control discount, but essentially this one individual family member is able to carve up their holding and manufacture their own discount by making fractional gifts here, which seems intuitively like it would not be okay. But in this ruling, that outcome leading to a lack of control discount was blessed. Now, this wasn't a new issue. The IRS had previously taken the position in Revenue Ruling 81-253 that no discount for lack of control should ever be allowed for transfers of corporate shares between family members in the situation where family members as a block held control of the corporation. So in other words, if family members together owned more than 50% of the corporate stock, previously, this old revenue ruling said there could be no discount for lack of control. But there have been some cases that came out in the meantime that held otherwise. One cited in our new ruling, Bright versus United States out of the Fifth Circuit in 1981. And what happened in this new ruling is the IRS acquiesced to some of those intervening cases to reverse course and override Revenue Ruling 81-253 and now hold that family control is not a factor when determining a lack of control discount for gift transfers. So in other words, the IRS no longer will aggregate interests of family members to deny a lack of control discount where family members in the aggregate hold control, at least where a corporation is involved. Now, since then, this has been, extended in various forms to a number of different entities. But if nothing else, this kind of creates the keystone of a tool in the estate planners or tax planners tool belt, and that's the discount for a lack of control when transferring minority interests in an entity. But there's sometimes battles regarding discounts between somebody making a gift and the IRS, but it's more the exception than the norm that the IRS will just deny a discount entirely for gift tax purposes. But they don't like having to go in and hire their own experts and have to figure out what an appropriate discount might be, because that takes time and money. So instead, more often what the IRS is doing is looking to who creates a family entity, especially if there's one substantial contributor who creates the entity initially, and when that substantial contributor dies, they're looking through that entity to, like that majority control we talked about and everything like that, to determine if through that majority control, that substantial contributor retained rights over the contributed property for estate tax purposes at death. And this latter point has the effect of really removing the discount and subsequent appreciation in contributed property for estate tax purposes. So since they cannot deny a discount entirely for the transfer of the entity interest, the IRS is finding a way to deem this as being a transfer of the underlying assets at death and not a lifetime transfer of the entity interest itself, which is the genesis of a new course I have going right now and developing that you'll see after this one on my YouTube channel dealing with family limited partnerships in Code Section 2036. So I'd encourage you to listen to that when it comes out. Subscribe if you want to see that coming down the pike. But in the meantime, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you again for listening to this presentation, and I look forward to seeing you in my future content.